Thank you all for attending this webinar tonight. Thank you to NextWise for organizing it and give me the opportunity to explain the content of APTimum reports. So my goal tonight is to explain the risk indicators that we compute and more generally to explain you how you can use and leverage risk analysis to build your portfolios more efficiently. So I will share my screen. I hope you can all see my screen.
Yes.
Okay, great. So if you have any question during my presentation, feel free to interrupt. Or if you prefer, we can I can answer those questions at the end of the session. So just before we start, please let me quickly introduce myself and introduce the company. So my name is Karim Jacquelin. I have a risk management background. I started my career in 2008 at Crédit Agricole, a French private bank, and I was managing the risk of the funds and the mandates of the company. So I've been doing that for 2 years, and then I joined APTimum. APTimum is a Paris-based company, and the mission of APTimum is to leverage the APT risk system. You can see in this slide that APT is at the heart of our activity. We have mainly 4 core businesses. The first one under APTimum Conseil is to sell this risk model to private banks, asset managers, family offices, pension plans. So what we basically call the buy-side industry. And we have been doing that for many years, more than 30 years. APTimum Formation Développement is a quant team dedicated to add value to APT users. So we do some implementation, some software customization, and we also act as an outsourced risk management function. So some clients prefer to use the system on their location, some prefer to outsource it. So we receive the composition of the portfolios, we do the computation, do the analysis, and explain it to the client, to the board, if there are some committees. We are also very involved in research and in education. So I'm teaching some classes at University Paris Dauphine and also at IAE Nancy in France. Next activity is FundClass. So FundClass is also leveraging APT. It's a fund rating agency. So we categorize funds based on their risk profiles. We create categories. And once we have those categories, we can rank the funds in terms of their risk-adjusted returns inside those categories. And the last activity, Fair Cost Index, created 10 years ago, creates some indices based on the risk profile of the market. We optimize the market in order to create indices that replicate the market in the more efficient way. So now let's begin with the topic of today, which is to explain risk and how you can manage risk to improve your portfolio. Let's start at the beginning with a definition. So risk and market risk can be defined as the uncertainty in my future wealth value, which is driven by constantly changing market prices. So I don't know the price of my asset tomorrow. I don't know the price of my asset in 1 week, in several weeks, or in several years. So this is risk because there is uncertainty in my future prices because I can't know them. There is some risk. This is the definition of market risk. But if you are a portfolio manager, you may face some other risks. So you can see in this box, you have several risks: market risk, credit risk, liquidity risk, operational risk, brand risk, and legal risk. And all those terms that you may face as an asset manager can be defined with the word uncertainty. So you can have uncertainty with your market risk, your credit risk, or liquidity risk. You can see that we have two colors to distinguish those risks. So we have some risks that are in green and some risks that are in orange buckets. There is a fundamental difference between the green risk and the orange risk. And the difference is that the risk in green, the portfolio manager is intentionally having this risk in the portfolio. And the reason why we want to have those risks and to be exposed to those risks is because you get some reward if you carry this risk. So this is what we call the risk premium. On the other side, you don't have any upside. You only have downside if you have some operational risk, brand risk, or legal risk. So there is a reward to bear market risk, credit risk, and liquidity risk. And just to illustrate this, I would use this simple graph. So let's say that you invest, let's say $100 or 100 euros at the beginning of the period, and that you invested in risk-free assets, meaning that you don't have any uncertainty on the future value of these assets. And let's say that let's consider that the risk-free rate at this time is 2%. So it means that at the end of the period, which is here 10 years, the portfolio value will be more than 120, so more than 20% performance over the period. This is what you get if you invest in the risk-free rate, in the risk-free assets. Now, if you have more ambition and if you are trying to achieve more important return, let's say that you are targeting a 7% expected return. So at the end of the 10 years, the value of your portfolio would not be 100, but it would be 200. So you have doubled the value of your portfolio. But the counterparty of trying to achieve this 7% expected return is that you will take some risk. And the way you could visualize the risk and this uncertainty is with the use of these risk envelopes. So you can see that you have a first risk envelope in dash green. And this zone represents the uncertainty of the value of your portfolio with a probability of 68% under certain assumption. For the moment, we will just assume that returns are normally distributed. So if the returns follow a normal distribution, you have 68% that the portfolio value will remain inside this first risk envelope. And this risk envelope is computed using an ex-ante volatility of 15%, which is basically the average volatility of equity markets. And you have a 96% probability to remain inside this second risk envelope. So this means that during this period, you may face some loss. So you have the downside here that is represented with the maximum drawdown, and you can experience loss of more than 30% if you invest in equities. But if your horizon is long enough, you can recover the capital after 10 years, even under extreme scenario. So this is the downside of risk. And when we consider risk, we usually think about downside, but there is also some upside, which is the blue line, so the expected return, but also the positive scenario that could make that your performance is above this 7% expected return. So no risk, no reward. We all know that. And if you are trading as an amateur or like an hobby, you will take some risk. Professional investors, they will also take risk. As long as you are investing, you take some risk. The difference between a professional investor and an amateur investor is that the professional investor measures the risk. So you need to be able to quantify the risk you are taking. And more than that, you need to be able to understand and to manage the risk of your portfolio. So this is why we are providing you with some risk reports so that you can quantify the risk, analyze it, be able to decompose it, and to manage it. So we provide several reports, top-level reports, and more detailed risk reports. So the first one, and I will go directly to this bubble chart, is this one. So in this bubble chart, we have two dimensions. The first one is the risk, computed as the ex-ante volatility of your portfolio as of the calculation date. So this is the risk of each portfolio as of end of yesterday. This is on the x-axis. On the y-axis, you have the performance of your portfolio from the beginning of the period to the end of the period. So you can see in this graph that you have some portfolios. I'm showing the bubble map for the clubs, but we also produce it for the individuals. So you have some portfolios with extreme risk levels. So volatility superior to 30% is a very important volatility. So those clubs are taking very high risks. So it's likely that they invest in some cryptocurrency or maybe leveraged ETF. And we have a population of clubs here with the less risk. If you want to zoom and have a clearer view, you can select the area here, and the graph will zoom on a subset of this graph so that it's more visible. So if I remove the clubs just for 1 minute, you can see that you have two bubbles here. So you have the green bubble. So this is the aggregation of all the clubs. So the aggregated portfolio of all the clubs, including cash. And you have a second bubble here, which is NextWise risky, which is also the aggregation of all the portfolios, but excluding cash. So it's only the invested part of the portfolios. So as expected, the risk of this fully invested portfolio is higher than the risk of the portfolio, including cash, that does not have any risk. So it can help you to compare the positioning of your portfolio compared to the population. So if you are on the right of this green bubble, it means that you are riskier, you have more risk than the average population. If you are on the left side of this bubble, you have less risk than the aggregated population. The red line represents a slope of 0.3. So it's a return to risk ratio of 0.3. It's just a reference point so that you can position your portfolio in terms of risk-adjusted return compared to this reference risk-adjusted return of 0.3. Another functionality that can be useful, you have a search bar. So if you are looking for your club, and if you can see it inside this huge amount of data, you can just type your portfolio, your club name, and you will be able to locate it inside this graph. And at any time, you can reset the zoom so that you can see the full picture. So this is the first report. We produce it for clubs, but we also produce it for individuals. So this is the graph for individuals, and you can see that you have more points. So the zoom functionality may be even more useful in this case. Here I'm showing you the graph of individuals as of 2023. So there is an interesting point here. You can see this individual has a very negative performance. So the performance was minus 90% for this portfolio, which is very bad. So how can you lose more than 90% of the portfolio value? There is only one way you can lose so much money. It's to invest in only one security, and that this security value go to zero. So this is what happened for this poor individual, and unfortunately, its performance was very, very bad. So this means that beyond the portfolio volatility, you need to have other risk indicators to control other aspects of your portfolio. So you need to quantify the absolute level of your risk, but you need to monitor other aspects like diversification, because the problem here was a problem of diversification. Decomposition of your risk. You need to be able to understand where the risk comes from, what position contributes to your volatility or your value at risk. Factor exposures are also important. You need to understand if you are exposed to growth, to value, to different sectors, to different regions. And this is why we also produce some more detailed risk reports that I will explain. So just before we go to the detailed reports, you also have some a risk dashboard that you receive in an Excel format, where you have all the clubs. So you have the asset under management. So the first line represents the aggregated portfolios. So the pooled composition, including cash, the pooled composition excluding cash, so only the risky assets, and the cash. So you have the volatility for each of those portfolios, the performance, the investment rate. So in this case, for the pool composition, you can see that the investment rate is 60%, which means that on average, the clubs have 40% in cash. The number of securities, and some indicators that I will explain in the detailed risk reports. So this is the report you should receive if you are a club on a daily basis. So it's a two-pager with a detailed risk analysis of your portfolio in absolute, but also in relative against a benchmark. The benchmark that we selected for all clubs is the risky portfolio, so the aggregated portfolio of all clubs. So it's not always relevant because your strategy may be very well different from the average population, but we can replace, if you wish, we can replace this benchmark with some custom benchmark, and we could also use the FCI indices so that you have a more relevant benchmark to run the relative risk analysis. So let me go through the different sections of this report. So the first section is a top-level risk analysis. So the volatility, the ex-ante annualized volatility for this portfolio is 19.4%. So you can see that it's slightly lower than the benchmark volatility, which is 21.3%. This ex-ante volatility is based on the composition as of today and based on APT risk profiles, which allows us to decompose your risk into systematic risk and specific risk. And this decomposition is very important. So systematic risk is the risk of the market. So it's the risk that is shared by most securities. It means that, for example, if interest rates goes up, or if oil goes down, or if equity market goes up, all instruments will be affected. So it's shared risk. This is systematic risk. Specific risk, on the opposite, is attached to the individual security. And this specific risk is independent to all the factors, to all the systematic risk, and they are independent one to the other. And a good property of specific risk, because they are independent, is that because if you diversify your portfolio, so if you have many securities in your portfolio, let's say 30, 40 security, the specific risk will vanish and you will only be left with systematic risk. So it's important to have this decomposition because you can try to understand the style of your portfolio. If you have a lot of specific risk, so in this case, it's not really the case. We only have 6% of the volatility that is specific. But if you have a lot of specific risk, it's an indication that your portfolio is not well diversified. Because if you diversify your portfolio, you will only be left with systematic risk. For the benchmark, which is highly diversified because it's the aggregation of all clubs, you can see that the proportion of specific risk is very low. 99% of the risk is coming from systematic risk. Next subsection, value at risk. So here, these are indicators to estimate extreme losses. So we compute the value at risk using two parameters, the confidence interval, which is 99%, and the horizon, which is 1 day. How do you interpret value at risk? Value at risk is the maximum loss for a given confidence and a defined horizon. So in this case, we have a value at risk 99% 1 day, which is 3.5%. So this means that in 1% of the case, you will lose more than 3.5% over 1 day. And you have a 1% probability to lose more than 15.4% for this portfolio over an horizon of 20 days. You can see that it's in green because there are in the real life for what we call UCITS funds, there are some limits that you cannot exceed. And the limits for UCITS funds is 20% for value at risk, 99%, 20 days. So if you are below 20%, you are good and you are UCITS compliant. And usually 20% value at risk corresponds to a 30% volatility. The CVAR is a technical indicator. So it's the average loss if you are beyond this 99% confidence. So it's the average loss if you are in the 1% of the worst case scenario. So it will be always higher than the value at risk. So in this case, it's 33.7%. Then you have the investment rate. So in this case, the investment rate is very high. The portfolio only has 5.5% in cash. The rest is invested in risky assets. The next section is very interesting because you can understand the level of diversification of your portfolio. So you have several interesting risk indicators here. The first one is a very simple one. It's a number of securities. So this portfolio has 28 securities. The aggregated portfolio has 233 securities. Then we have some indicator of concentration. So we have the HHI, the Herfindahl-Hirschman index, which is a metric used to monitor the concentration of a market. But it can be used in your portfolio. Instead of market shares, you will use the weight of your securities inside your portfolio. And to compute this HHI index, you just square the weights of each position. You sum those squared weights, and you get this indicator. The lower the indicator, the more diversified you are.
Sorry, Karim, could
Yes.
you just please repeat what the benchmark is, please, for Leonardo?
Yes, sure. So the
Thank
benchmark, the standard benchmark we use is the aggregation of risky positions of all clubs. So we aggregate all clubs for all portfolios from all the clubs. We just remove the cash, the non-invested parts, and this is the benchmark that we use for this analysis.
Thank you. I understand. No, I have another question that
Of
is
course.
about the HHI index
Yes.
that I studied, of course, and I know that you take the market share of the single stock and you do the square root, etc. But if we take in this case a lot of ETFs, the square is done over the ETF or over the market share of the single
Yes,
firm in the ETF.
that's
Yeah.
a good question. So we don't use the square root, it's the squared. So I will just show you the function. The function is here. So we take the weights and we square the weights to compute this HHI index. Your question is a fair question. When you invest in ETF, it's considered as one instrument. So we don't use the look-through of the ETF. So it means that the HHI may be overestimated if you invest in an ETF. Because to do it correctly, we should use the look-through of the ETF, but we don't use the composition of the ETF, so it's not taken into account.
Okay, so for the aim of the competition, is important, for the points. So yeah.
Yes, of course. So when you analyze those risk indicators, you have to be aware of this. So if you only have one ETF, the HHI will be a maximum, and it will be 100. While in fact, in reality, you are more diversified than that. But it's also a way for you to, for us to encourage you to invest in multiple instruments. So maybe if you just invest in one ETF, it's not enough to build a solid portfolio.
Okay. And the aim is like 2%.
Sorry, excuse me?
The benchmark is 2%.
Yes, in this case, the benchmark HHI is 2%.
Perfect. Thank you.
So the HHI is a technical metric, technical indicator. There is, I would say, a more useful risk indicator, which is the effective number of securities, and it's directly derived from the HHI. So the formula is this one. So it's just 1 divided by the HHI. And it gives you the effective number of securities, which is more useful and easier to interpret. So we have the number of securities here, but let's say that we have 100 securities and that one security weight is 99%, and the other 99 weight for very small weights, so that it sums to 100. So technically, you have 100 securities, but in reality, because only one stock is invested at 99%, you have an effective number of securities of 1. So that's why it's useful not only to monitor the number of securities, but more importantly, you should monitor the effective number of securities. And it's quite interesting because here you can see that the benchmark has more than 200 securities, but the effective number of securities is 51. Next indicator, the diversification ratio. So the diversification ratio is this indicator. So it's computed as the weighted sum of the individual volatilities of the instrument in your portfolio divided by the portfolio volatility. So you know that the portfolio volatility not only depends on the weights and the volatilities of your securities, it also depends on the correlation between your securities. So if you invest in a portfolio with uncorrelated or low correlation across your assets, you will have a lower portfolio volatility due to this diversification effect. So if you divide this numerator that consider that all securities are perfectly correlated by the portfolio volatility, you get an indicator of your diversification. So once again, the higher the ratio, the better you are diversified. So 1.7 is a good diversification ratio. I would say that you should aim to have a diversification ratio of more than 1.5. It means in this case that the sum of the parts is 75% higher than the true volatility, which is good. So the 75% is a diversification benefit. The UCITS constraints are represented here. So if you want to be UCITS compliant, the maximum weight for each position should not exceed 10%. So if it's in green, it means that you are below this limit. The sum of the positions that are below those 10% but above 5% should not exceed 40%. And if you comply with those two rules, then the check will be okay. Performance, no comment on this. So this is just the performance from the beginning of the period. And on the right part, you have the relative risk indicator. So first, it's the overlap. The overlap is the percentage of position in common between the portfolio and the benchmark. So if you have a 100% overlap, it means that you own the benchmark. If your overlap is 0%, it means that the securities in your portfolio are all different from the securities in the benchmark. In this case, we have an overlap of 38%, meaning that we have an active share of 62%. So 62% of the portfolio is not in the benchmark, or the weights are different. So this is a good indicator of your relative risk. Ex-ante tracking error is also an annualized risk indicator. So in this case, it's 6.9%. So it means that you have a 68% probability that your portfolio performance minus the benchmark performance will be between plus 6.9% and minus 6.9%. So if you have a 68% to remain inside this range, it means that you have 32% to be outside of this range. And if we consider that the risks are symmetric, you have 16% probability to outperform your benchmark by more than 6.9%, but also 16% probability to underperform your benchmark by more than 6.9%. So the lower the tracking error, the closer you are to the benchmark. This tracking error is also decomposed in terms of systematic and specific risk. We have other risk indicator like tracking at risk, 68%. So this represents the extreme risk. This is the worst case scenario. So the maximum deviation from your benchmark in case of extreme events. And the last relative risk indicator are the systematic correlation and the systematic beta to the benchmark. So if you have a beta to the benchmark that is inferior to 1, it means that you are more defensive to your benchmark. If it's superior to 1, it means that you will that you own a portfolio that is more aggressive than the benchmark. When you analyze the beta, it's important to also look at the correlation, at the systematic correlation. So the systematic correlation is an indicator ranging from -1 to +1. The higher the correlation, the higher the relationship, the linear relationship is between the portfolio and the benchmark. So if you have a correlation close to 1, it means that you are exposed to the same strategy. The portfolio is exposed to the same strategies as your benchmark. If the correlation is lower, 0.9 or 0.8, it means that you are exposed to different strategies. And if your correlation is too low, you cannot really use the beta to predict the performance of your portfolio, given the performance of the benchmark. So these are top-level risk analysis. We move to the next section. We can decompose those risk indicators, so volatility and tracking error, by position. So in this section, we display the top 20 position in terms of contribution to volatility. So in the first column, you have the weights. So you can see that the top 20 position in this portfolio have an aggregated weight of 79%. And you have the contribution to volatility. I give you the formula here. So the contribution to volatility is the product of the weight of the position, of the volatility of the position, and of the correlation between the position and the portfolio. And the nice thing with the contribution to volatility is that it's an additive measure. It means that if you sum all the volatility contribution, you get to the total volatility. So you have a way to split your volatility by position and to precisely quantify the contribution of each position to the total volatility of the portfolio. If you take, for instance, Alphen, the third position, so you can see that the weight is only 3.7%, but the contribution to volatility is 5.6%. Siemens has a higher weight. The weight is 4.3%, but the contribution to volatility is identical, it's slightly lower. Why? Because Alphen has a higher volatility than Siemens. You can also decompose the contribution to tracking error to understand where your relative risk comes from. In this case, you remember the tracking error was 6.9%. 9% of this tracking error comes from the fact that the portfolio is not invested in BNP Paribas. 8% of the tracking error comes from the fact that the portfolio is not invested in LVMH, AXA, and so on. So basically, this club does not invest in the CAC 40 securities. So this is the choice of the club, but this creates some relative risk compared to the aggregated population. So it's very good because you can understand precisely position by position where your risk comes from. Next section, the marginal contribution to volatility. This one is also very good and very interesting if you want to manage the risk of your portfolio. The marginal contribution to volatility is the increment of portfolio volatility you would get for a small variation of the weight of the position. And in this table, we sort the position by decreasing order of marginal contribution to volatility. So if you want to reduce the portfolio volatility, the most effective trade for this portfolio, if you have a limited amount of turnover, let's say if you don't want to sell more than 1% of your portfolio, the most efficient trade would be to sell McPhy Energy, because if you sell 1% of McPhy Energy, the portfolio volatility would go down by 1% multiplied by this marginal volatility. So it will go down by 0.37%. So it helps you to simulate the risk of your portfolio if you are changing the weight of the position. It can also be very useful if you want to increase some position and you want to limit the impact on the portfolio volatility. Then it can be interesting to add more weight, in this case, to Thermador Group Security, because the marginal volatility is lower. The marginal volatility is just a product of two terms. It's the volatility of the security multiplied by the correlation of the security to the portfolio. It's also very interesting because marginal contribution to volatility should represent the preferences you have in the stocks. And by preferences, I mean the expected return of the security. So when you build your portfolio, you may not have expected return at each position. But if you sort your position by marginal contribution to volatility, it gives you an indicator of the implied return that you should have if your portfolio is efficient. I will explain this with this example. So this portfolio has a 19.4% volatility. Let's say that I want to trade those two stocks, Total Energy and Engie. The marginal volatility of Total Energy is higher than the marginal volatility of Engie. So if I increase the weight of NG by 1% and I reduce the weight of Total Energy by 1%, the impact on my portfolio volatility would be negative. I reduce my portfolio volatility by the differential of the two marginal volatilities. So I reduce my portfolio volatility by 12 basis points. So it's now 19.3%. But let's say that my expected return for NG is higher than the expected return of Total Energy. In this case, with the same trade, I will increase my expected return because I increase the weight of the higher expected return and I reduce the weight of the lower expected return. So if I switch those two stocks, my expected return will increase. So I'm increasing my expected return and I'm decreasing my portfolio volatility. So if I'm a rational investor, I'm very happy because I have improved my risk-adjusted return. So this is why the order of the marginal volatility should represent the preferences, the expected return you have on your securities. And another way to use that is to look at the order and maybe consider, let's say that I prefer NG to GTT, for instance. So I'm safe at increasing the weight of NG and selling GTT because it would not deteriorate my portfolio volatility. On the opposite, it will reduce my portfolio volatility, and at the same time, it will increase my expected return. So this is marginal contribution to volatility. I give you the formula in this table. Now, second page. In this second page, we use the contribution to volatility at the position level that I have explained. But we aggregate those contributions to volatility according to asset type and sectors. So for asset type, we use this classification. So equity via stocks, equity via funds, cash, crypto assets, commodities, bonds, commodities, gold. We have the weights for the portfolio and for the benchmark. And we have the contribution to volatility per asset type. So because we can decompose the portfolio volatility at the instrument level, we can sum the contribution of the position for each asset type and get the contribution to volatility for each asset class. So in this case, because the portfolio is only invested in stocks, 100% of the contribution to volatility is coming from stocks. Of course, cash has zero risk, so the contribution to volatility is zero. And you have the same table for the benchmark. So contribution to volatility, standalone volatility for each asset type. Same approach, but using sectors only for equities. So if you invest in ETF or crypto assets or whatever, those instruments would be under unassigned section. We decompose the portfolio by sector in this case, and we have the exact same indicator. So you can see, for instance, that this portfolio is heavily invested in utilities, and this explains why the contribution to volatility is so high for this sector. And you can see that some sectors are not invested at all. Like information technology, 0% is invested in information technology. And because the contribution to volatility is the product of the weight, the risk, and the correlation, the contribution is zero. So this is an interesting view, but we can do better because the advantage of this view is that it's very easy to produce and it's very easy to understand because we decompose the risk at the position level and then we just aggregate according to any criteria. But there may be some cases where a stock, an equity, is classified inside one sector, but share risk with other sectors. So it's a simplification to assume that the risk of a security is the same as the risk of a sector. Just take one example. So Stellantis, so they are car manufacturers, they build cars. So it's classified as industrials. But if you decompose the risk, the sensitivity of this stock to the different sectors, you can see that a lot of the risk of this equity is coming from finance. So it's classified as industrial, but in terms of sensitivity, the equity prices is quite correlated to the finance sector. And this makes sense if you know the company. They have a bank that finances their customers. So they have like a small banking activity, which is not that small because it represents 20% of their revenue. So it makes sense that this company is sensitive to the financial sector. And if you take most of the security, they are sensitive not only to their the sector they are classified in, but they are sensitive to other sectors. And we use this factor-based analysis to try to understand the systematic risk of the portfolio in terms of different views. So we decompose the risk of the portfolio in blue and the benchmark in red in terms of sectors, in terms of regions, and in terms of styles. This analysis does not rely on the convention of the industry membership. It only relies on the sensitivities, the correlation of the portfolio to those different sectors. So if we look at the sector risk decomposition, you can see that the portfolio in blue is more exposed to the benchmark, to the energy sector. If we go back to the portfolio decomposition, indeed, you can see that we have 25% of the portfolio invested in energy, while we only have 12% of the benchmark invested in energy. So this is quite intuitive to have an overexposure to energy. But if you look at the information technology sector, and this is very interesting, you can see that the portfolio is more exposed to IT than the benchmark. But if you look at the portfolio decomposition and benchmark decomposition, you remember that the portfolio is not invested at all in information technology, while the benchmark has a 5% exposure, 5% weight to this IT sector. So why do we have a positive exposure to information technology? This is because some stocks like McPhy Energy, GTT, Technip Energy, so these are green tech, so they are positioned in the energy sector, but they are very sensitive to the technology sector. And at the end, they are correlated to the information technology sector. So this is the value of this analysis. It gives you the true exposure of your portfolio in terms of sectors, region, and styles. It means that if the information technology sector face a problem as a negative performance, it's very likely that the portfolio will underperform the benchmark, even if the portfolio is not invested in any stock classified in the information technology sector. In terms of region, it's quite aligned between the portfolio and the benchmark. And in terms of styles, you can see that the portfolio is more exposed to the growth style. It's less exposed to the value style, which makes sense because usually when you are exposed to consumer discretionary or information technology, you have usually a quite significant exposure to growth. Last section is the scenario analysis, stress testing. So we apply some historical scenarios to the portfolio and the benchmark, and we compute the expected performance of your portfolio of the benchmark if there is a replay of those different scenarios. So you have the great financial crisis in 2008, which is one of the most damaging scenario. You also have the coronavirus crash, 2020, and it can help you to understand if your portfolio, how your portfolio would behave in case of those scenarios, and what would be the relative performance between your portfolio and the benchmark. In this case, you can see that under any scenario, the portfolio would have a negative performance, but would outperform the benchmark. And this is because the portfolio is more conservative than the benchmark. You remember that the beta of the portfolio to the benchmark was 0.8%, 0.8. So this means that the portfolio is more conservative. So it's expected that the relative value change is positive under negative scenarios. And we also produce stress tests on prospective scenarios. So we have prospective scenario of negative 10% drop in North American equities and minus 10% drop in European equities. Okay, so this is the risk report and the final report. So the risk report is very important to build your portfolio, to understand them, to make sure that your portfolio is aligned with your convictions, with your preferences. So you can use the marginal contribution to volatility to check that. You can use the factor-based exposures to make sure that you are exposed to the sectors or to the region you want to be exposed in. Once you have created your portfolio will have a performance, and it's also very interesting to understand this performance and to decompose it at the position level, to understand what stocks have contributed positively or negatively to the performance of this portfolio. And this is the purpose of this last risk reports, where you can have some indication on the performances over multiple horizons, so 1 month, 3 months, and 6 months for the different stocks in your portfolio. Okay, that's all I have for you today. If you have some questions, I'm happy to take them.
Thank you, Karim. Thank you very much for this presentation. Yes, please go ahead for your question, guys. Feel free to unmute and speak up, or if you prefer, use the chat.
Hi, yeah, sorry. I wanted to ask for the unclassified assets, how they affects portfolio efficiency. And like I bought with my team EMU value ETF, and it results of course unsigned, but of course we bought an exposition on value factor that doesn't result.
What's the name of your club?
Minerva Investment Fund.
Minerva. Okay.
Yeah. Also I just bought also in my individual account the ETFs on EMU value, and it doesn't appear like a factor or industrial.
Okay, so what's the name of the ETF? A value?
EMU value. EMU value.
VMU value. So
No,
this is an
EMU.
EMU.
Okay,
Okay.
Europe. Yeah.
Okay, yeah. Okay, I get it. So so you have bought an EMU value ETF. Okay.
Yeah.
And what's the question? Sorry.
That in our factor
Okay.
factors exposition, it doesn't result on value at
Okay,
because it's as nice.
That's interesting. It depends on the weight of the you have invested in this ETF. How big is the position in your portfolio?
It is equally weighted 7% for now.
Okay. So okay. Interesting. So what I propose is that I will take this question. I will have a look at your risk report, and I can try to explain you why it doesn't show up in the factor-based analysis.
Okay, perfect.
It's
And just
probably due to the rest of the portfolio, because maybe you have invested in value, but maybe other position offset this value bias, and you, at the end, maybe are not that well exposed to value. That's an interesting question. Let me take this, and I'll revert back to you.
Okay, perfect. Thank you.
Any other questions? No questions. So that means everything was perfectly clear, right, Karim?
It's still time to ask questions after the webinar. Don't hesitate to use the chat in the application. I received your questions, and I'm very happy to answer to your question and to help you to better understand the risk reports, so that you can manage your portfolio efficiently and take the opportunity of this challenge to learn and to try to understand those different risk indicators that are very useful when you manage a portfolio.
Thank you so much, Karim. And thank you all for joining us today. And the replay will be available on the NextWise platform in the coming days. And so we look forward to seeing you there. And maybe we can wish you now a wonderful evening.
Thank you so much, everyone.
Thank you.
Have a good evening.
Thank you.
I have a question.
Yes.
Just to be clear. I found this explanation very clear, and just to be sure, I wanted to know if this material, as Roxana said, will be available on our email, like so we can focus more on the data and study better.
Yeah, there will be a replay.
Yes.
And I think the slides also will be shared to the participants, if I'm not mistaken.
That's correct. Yes,
Okay,
that's correct.
because I didn't receive this report, so I don't know if it's possible to send it now to my email, just to.
You mean the presentation or the report? The presentation, yes, we will send it to you tomorrow.
Explained by Karim. Okay.
Yes, it will be sent tomorrow.
Do you receive the risk reports for your club or your portfolio as an individual?
I didn't receive it because my portfolio is individual. Yes, I just applied like 3 days ago.
Okay.
My performance is going good, but I wanted to.
That's good.
Yeah.
Yeah, for the club, we produce the reports on a daily basis. For the individuals, it's at least weekly. So if you have started 3 days ago, maybe you have not received it yet.
Perfect. Just interested into the slide that you presented this evening.
I will send it to you.
Thank you so much.
You're welcome. Okay, so thank you everybody. Thank you, Karim.
Thank you.
And have a nice and wonderful evening all. Thank you.
Thank you.
Bye-bye.
Everyone.